Now that we've wrapped up our discussion of lease reassessments, remeasurements, and modifications, let's shift to another topic within subsequent accounting: lease impairments. Unlike remeasurements and modifications, ASC 842 does not provide detailed guidance on when and how to test for impairments. Instead, right-of-use assets follow the same impairment framework that applies to all long-lived assets, which falls under its own topic, ASC 360. Because ASC 360 is extensive and could easily require its own series, we won't dive into how to calculate fair value or perform the impairment test itself. Instead, we'll assume that any required impairment analysis has been completed under ASC 360, and we'll focus here on how to account for a right-of-use asset under ASC 842 once it's been determined to be impaired. So as we've done in prior episodes, let's begin with what ASC 842 does say about impairments. Paragraph 842.20.35.9 states that a lessee shall determine whether a right-of-use asset is impaired and shall recognize any impairment loss in accordance with Section 360.10.35 on impairment or disposal of long-lived assets. And again, our focus here is not on ASC 360 itself, but on the accounting under ASC 842 once an impairment has been recognized. ASC 842 also provides guidance in paragraph 842.20.35.10, which states that if a right-of-use asset is impaired in accordance with paragraph 842.20.35.9, after the impairment, it shall be measured at its carrying amount immediately after the impairment, less any accumulated amortization. A lessee shall amortize in accordance with paragraph 842.20.25.7 for an operating lease, or paragraph 842.20.35.7 for a finance lease, the right-of-use asset from the date of the impairment to the earlier of the end of its useful life or the end of the lease term. So one thing you'll immediately notice is that impairments are much simpler than remeasurements or modifications. Impairments focus solely on the right-of-use asset, not the lease liability. And this makes sense. Under US GAAP, an asset represents a present right of an entity to an economic benefit. If the right-of-use asset is no longer expected to provide economic benefits that justify its carrying value, we impair the asset under ASC 360. But an impairment does not change our contractual obligation to the lessor, so the lease liability remains unchanged. We still owe the same payments, regardless of whether the asset continues to generate value for us. So if an impairment is recognized, we'll re-record the right-of-use asset at its impaired value under ASC 360. The entry is a credit to the right-of-use asset and a debit to impairment loss on the P&L. After that, ASC 842 requires us to amortize the impaired right-of-use asset in accordance with paragraph 842.20.25.7 for an operating lease, or paragraph 842.20.35.7 for a finance lease. So for an operating lease, paragraph 842.20.25.7 states that after an impairment, total lease expense is calculated as the sum of two items. First, we amortize the remaining balance of the impaired right-of-use asset on a straight-line basis, unless another systematic method more faithfully represents how we expect to consume the benefit of the asset. Second, we recognize interest on the lease liability using the effective interest method, producing a constant periodic discount rate over the remaining lease term. So in simple terms, once an operating lease right-of-use asset is impaired, our operating lease expense is calculated as the combination of straight-line amortization of the right-of-use asset and the interest expense calculated on the lease liability using the effective interest method. And that should sound familiar. You may notice that this is identical to how we recognize expense for a finance lease. A finance lease always includes straight-line amortization of the right-of-use asset and interest on the liability. The only difference is presentation. For a finance lease, amortization and interest are shown separately on the P&L. For an operating lease that has been impaired, those same two components are combined into a single operating lease expense. For a right-of-use asset in a finance lease, ASC 842-20-35-10 requires us to continue amortizing the asset in accordance with paragraph 842-20-35-7. That paragraph does not provide any special rules for impairment. It simply states that finance lease right-of-use assets are amortized on a straight-line basis, while interest expense is calculated separately using the effective interest method, just as we would at any other point in the lease. And that's the full picture for impairments. When a right-of-use asset is impaired, we reduce its carrying amount and recognize the loss under ASC 360. After the impairment, the right-of-use asset is amortized on a straight-line basis over the remaining lease term, or in the case of a finance lease, over the asset's useful life if that's shorter than the lease term or if ownership transfers at the end of the lease. The mechanics of amortization are the same for both classifications, but the income statement presentation differs. Finance leases present amortization and interest separately, while operating leases present the combined amount as operating lease expense. So in the next episode, we'll walk through a quick example of an impairment of an operating lease and see how this process works in practice.